One of the things that listeners, when I talk to them, talk about value, say, value. I don't want to get stuck in a value trap. This thing's cheap for a reason. It's going to underperform. It's going to disappoint, blah, blah, blah. You guys have done a fun series on the phrase, which I don't think I've seen before, called growth traps. You guys want to give us a quick overview of like what that general methodology and insight was?
So, we came into this by trying to come up with a decent definition of what a value trap is. I think everybody, well, not everybody, but probably just about everybody who listens to your podcast has an idea of what a value trap is, right? It's a company that looked cheap, but turns out not to be cheap because the fundamentals wind up deteriorating a lot relative to what expectations were. So you bought this company and then, the bottom fell out of the fundamentals. So we came up with this quantitative definition of something that is a value trap in a given year. And so we were looking for companies within the value universe that not just disappointed in a given year, but where beyond the problems of this year, the market is also saying, hey, we think the future has deteriorated materially as well. So we came up with this quantitative definition, and we could say, yeah, actually, almost a third of the value universe winds up being a value trap in a given year. And this group stinks. They underperform value they underperform the rest of value by about 15% per year. So you do not want to own these guys if you could avoid them. We came up with a couple of interesting findings once we had this definition of what a value trap was. One of them was, okay, what is the likelihood of being a value trap given that you were a value trap in the prior year? So you've got a company, they disappointed this year, they were a value trap. Does that mean you should sell them out of your value portfolio or not? And it turns out whether you were a value trap in the prior year has no bearing on whether you are going to be a value trap this year. So one of the difficulties for value managers is, yes, it would be great to avoid these stocks because they underperform by 15% a year relative to the rest of value, but it's not that easy to predict who they're going to be. And the problem of being a value manager is, man, it would be great if you could figure out who these guys were going to be. And we haven't figured out an easy way to do that, although there are some things we do that we think can help. But the other thing we were able to do with this quantitative definition is value stocks are not the only kind of companies that disappoint. And so we could look at stocks in the growth universe that had that same pattern where they disappointed in the course of a given year and their future growth prospects fell as well. And the thing about that group is that group does even worse. So I said those value traps underperform the rest of value by about 15% per year. Those growth traps, those disappointing growth companies, underperform the rest of the growth universe by almost 23% per year. And it turns out they are at least as big a piece of the growth universe as value traps are of the value universe. So the thing on behalf of value managers everywhere that seems a little bit unfair is every prospective client, and frankly, all of our current clients, when they come in, one of the initial questions is, all right, how are you guys going to avoid value traps? Because we know value traps are horrible. I would like it to be the case that when investors are speaking to their growth managers, they start asking them, well, how are you going to avoid these growth traps? Because growth companies that disappoint are death in your portfolio. So these growth traps are a really nasty piece of the overall universe. And actually, one of the you've got to be the right kind of nerd.
This is fun to our listeners. I mean, you don't listen to the Meb Faber Show podcast unless you get hot and heavy for quant factor insights and macro. I mean, you're talking to our people, Ben.
All right. Well, then for the quant factor nerds.
And my mom listens to every episode too. So shout out, Mom.
The interesting thing, 2022 was a horrible year for growth stocks relative to the market, the worst year since 2001. And I'd say the common narrative is, well, interest rates went up. And when interest rates went up, people just knocked down the valuation premium they're going to have on growth companies. But something else happened last year as well. An almost record high percentage of the growth universe turned out to be growth traps. And that's funny because that normally happens in recessions. Like the only time where a higher percentage of the growth universe wound up disappointing in that way was in the global financial crisis back in 2008, 2009. But last year, over 70% of growth companies wound up disappointing not just on 2022, but on forecasts for what was going to be happening in 2023. And I think, part of what was going on was 2022 was a surprising year in a number of ways. But one of the ways it was surprising is how quickly the economy got back to something more normal. A normal pattern where people were buying less goods and more services and going out to restaurants and doing more travel and all of that stuff. And the companies that had been the biggest beneficiaries of stay at home and do everything on a screen wound up being disappointing, and to differing extents. I think, Apple Computer last year wound up disappointing on revenues by maybe 4%, and their future revenues came down by about 4%, whereas some of the high flyers saw much bigger disappointments. But 2022 was actually a record bad year of growth traps.
And to your point earlier, I think that the disappointments were most damaging when it was revealed that what growth they were having came at very high levels of capital being deployed. So it wasn't just that the growth wasn't happening, it was that money was being lit on fire to get what was kind of temporary growth, that not a permanent thing. You show your age, by the way, Ben, to refer to Apple Computer.
Oh.
I thought you guys were going to say making it rain with all this stock-based compensation, which the tech world in particular has been particularly fond of the last 5 years. Is there any way to try to identify these traps ahead of time, you guys think? Does momentum screening help at all? Is it they give up any warning lights on before they take a big dirt nap?
There's definitely nothing foolproof. There are a number of signals we have seen that tend to be associated with kind of future fundamental problems. But honestly, momentum itself is, in general, a good thing. A stock that is exhibiting strong momentum is generally one that is more likely than the average stock to have a positive surprise rather than a negative surprise. The difficulty, the tricky thing about momentum is when they have that negative surprise, bad stuff can happen. So NVIDIA would be a great example, a company that had, positive momentum going into an earnings announcement, which turned out to be an incredible earnings announcement, and the stock went up a bunch. Imagine what would have happened to NVIDIA if they had come out with a negative surprise after that momentum. That would have really stunk. But on the other hand, is it a shock that NVIDIA, where investors were saying, hey, good things are happening, I want to buy this stock? Is it a surprise that it wound up with surprisingly good numbers? I suppose some definitional way a surprise has to be surprising. But on average, good momentum is associated with positive surprises, not negative surprises.
I mean, I would focus, not to sound like a broken record, but a focus on return on capital, or companies that have gotten their growth with relatively little investment. Not so much that those companies, and NVIDIA would be one of those companies, not so much those companies can't surprise dramatically in either way, but I feel like for those companies, time is your friend. Right? If something bad happens and the growth is broken, it's much more likely to come back the year after that rather than start some downward death cycle. For at least for the longer term investment, I'd focus mostly on that. From a factor point of view, the best thing I've ever seen predicting future growth is just high multiples, and that predicts fundamental growth. It doesn't help you very much for picking stocks, though, because that's basically predicting the growth that everybody else knows is already there and is already priced.